Well, it gives me great pleasure now to bring on board Prashant Jain, CEO and founder of 3P Investments, to first decode the impact of budget, make sense of what's happening in the world in terms of Trump tariff. Everybody wants to know what his view on small and mid-cap stocks is and where is he picking values. Let's first understand the tone and tonality of the budget in terms of government messaging. The general view in the market is that the capex cycle has peaked out, a new consumption cycle has started, it's time to pivot. What should one do based on this year's budget in terms of a market and a portfolio approach?
I think, Nikunj, first full marks to the budget. I think it was a very good budget. I mean, no surprises. And I think it struck a very good balance between fiscal consolidation, continuing fiscal consolidation, and giving a fillip to consumption, which has been rather weak. I think we wrote even last year probably, or I think that was a general expectation also, that government has done the heavy lifting in terms of its share of capex. And if you look at the increase of government capex as percentage of GDP, it has gone up significantly from the COVID times. So I think going forward, I would expect government capex to grow by and large in line with the nominal GDP growth. So I don't think there are any surprises out there. Coming to markets, I feel while the support to consumption, I mean, the steps taken will impact consumption positively. But I think we have to be slightly cautious, at least on the consumer staples space. One, if you get a little more money, you don't rush to buy soaps or shampoos or toothpaste or biscuits. But it could help a little bit the discretionary space, I feel. And which is where the multiples are also somewhat reasonable. I think consumer staple growth is unlikely to be impacted, and multiples, while they have derated, they continue to be above my comfort level. Coming to capex, I think the wherever we have seen narrative-driven stock movements, whether it was manufacturing, capex, I think these narratives are right directionally, but the stocks have far exceeded what is realistic to expect. So I would expect that capex should continue to grow faster than consumption, and private capex should also revive. Probably it is reviving also, it is growing faster than GDP as well. I think that should continue. But the multiples leave very little room for comfort in that space, yes.
So even though markets have corrected, Nifty is down in double digits, small and mid-cap stocks are down 25 to 30%, even more in some cases. You don't still feel that markets are attractive enough?
I think, Nikunj, Nifty is coming to levels where I think it is reasonable to expect modest returns, low double-digit returns over a 2, 3, 5-year period. I think Nifty has come to those levels, in my opinion. And what happened in the last fall, if you see, the banks and IT have not fallen much. They have hardly fallen. The bulk of and these sectors were underperforming over the last couple of years. On the other hand, the sectors that were outperforming, like consumer staples, like automobiles, like utilities, like oil and gas, these stocks have fallen far more sharply. And therefore, these sectors which are appearing to be expensive, I think are beginning to offer decent value. Net, I feel Nifty is at fairly reasonable levels. I mean, short-term downside is always possible in markets. If markets can become overvalued, so can they become undervalued for short periods. But if we take a 3-5-year view, I think Nifty should be able to deliver low double-digit returns to my mind. Now, coming to small and mid caps, I think there, despite this correction, what we have seen, I think the valuations still are substantially out of sync with the earnings and the likely growth thereof. So I would continue to be extremely cautious in that space.
Mr. Jain, you've always been a big votary of cycles. For example, when you bought into PSUs. For example, when you bought into corporate banks. You bought into manufacturing and power a few years ago. What cycle is this market currently in? And what cycle do you think? And in this cycle, what could underperform and outperform and underperform?
Nikunj, this is a very unique market, and for the first time in my career of almost 33, 34 years, I am seeing that nothing is sharply undervalued. And in the past, we have seen when a part of the markets became very expensive, it was at the cost of rest of the market. Like technology was very expensive in 99, rest of the market was very cheap. In 2007, we saw capex, utilities, NBFCs become very expensive, and consumer and pharma were very cheap. In 2015 and thereafter, the banks, the PSUs became extremely cheap. And so, but in this market, it's a unique situation. There is nothing which is offering deep value to my mind. And the dispersion in valuations is rather low. And therefore, we think it makes sense to run a more diversified than usual strategy in these kind of markets and clearly focused on large caps. Having said that, I still feel to a small extent the banks look relatively better, the large banks, as I've been saying for some time. And I would still be slightly cautious. I think there is still room for derating in the consumer staples space. Thank you. Yeah.
Right. So in this market, you will not be buying staples at all, even though the push towards consumption is there. So if there's 1 lakh crore which comes back into the economy, you mentioned few themes, but additionally, where do you think the spend would move? Because the way India was consuming earlier versus where India is consuming right now, that also is changing.
Well, Nikunj, you are right. And see, there are two things here. One, the consumption basket, the lifestyles are clearly undergoing a change. People want to spend more on experiences around electronics. That is pretty clear. And see, by very definition, consumer staples is a category which is a necessity. So if you get 5,000, 10,000 rupees more, especially in the tax paying class, I don't think it will move the needle for the consumer staples category. I think that money could probably go towards buying more automobiles, buying more discretionary goods, uh, some electronics, eating out, basically discretionary pockets of consumption.
What about the classic Build India themes? For example, you were bullish on manufacturing. You were very bullish on power. Is the party over there?
See, I think manufacturing is a not an easy theme for India. We have a right to win. We have factors, a supportive global environment, and we have the potential to succeed. But I think a lot of work needs to be done before it can really start firing. And our companies will need to invest a lot. Fortunately, the government is extremely supportive. But given the very nature of manufacturing, it takes a while before it starts showing results, especially if you are talking in terms of value addition. So I think it's a theme which will play out over next 5, 10, 20 years. But stock markets, when they take up a stock 5 times, 10 times in a 1 year, 2 year period, the implied growth rate is much higher compared to the likely or realistic growth rates. So therefore, I would be cautious in that space until the multiples come down. That space has some very high quality companies and which should continue to grow, to my mind, above GDP growth rates. But still, the implied growth rates are not comforting at all. I think with regards to the power sector, I think the you have to value, if you are talking of power utilities, whether you are in conventional or in new energy, I mean the renewable powers, the return on equity is in low double digits. So wherever you see value, according to that, I think it is reasonable. And we have seen some very large power companies have corrected very sharply, almost 25, 30%. As I said earlier, that the non-banks, non-IT stocks have corrected a lot more in the last 6, 9 months. So I think valuations have once again become reasonable, but clearly one will have to be selective based on the stocks in that space because not everything is cheap there.
What is your view on high growth companies? I'm referring to consumer tech, fintech. You do have some exposure, not a large exposure, to some of these consumer tech and fintech. These are high growth companies. Some of them are propelled by the so-called Gen Z and the change in middle class consumption patterns. Where are they headed and how would you value them?
I think it's difficult to value these companies. So we were lucky we bought them very cheap, and at these prices, we are also in two minds because the implied growth rates are again pretty demanding. So at this point, I don't think we have a strong point of view either way. But this is a space that should grow at significantly ahead of economic growth rates. But as we have seen time and again in the past, when growth gets over discounted, despite the growth, stocks may not turn out to be good investments. This happened to technology in 99. It happened to infra companies, power companies in 2007-8. It has happened to the retail banks and to the consumer staple companies in last few years. So I would, but at these prices, we are also contemplating what to do in this basis.
Where are you finding comfort outside Nifty 50? I mean, all your portfolio cannot be Nifty 50. It will have some non-Nifty, Nifty 50 stocks. It will have some names which could come under the category of, small and mid cap. Where are you finding comfort then?
So I think in small mid caps, it is really a struggle. And today, our portfolio is substantially, I would say, aligned to Nifty. Within Nifty, of course, the weights can be different, are different. But I think outside Nifty, it is really difficult. You look at 30, 40, 50 stocks, and then one or two make sense. So it is like finding a needle in a haystack. So, and we have also seen that when small mid caps fall, even the good undervalued companies will fall. Maybe not as much others, but they will fall. So I would say the primary focus at this stage should be in Nifty companies or similar companies. Yes.
Thank you for being so clear and articulate. I mean, you're clearly messaging that, look, this is this is what you are doing. Everyone has a different kind of an approach, but this is how Prashant Jain is really approaching the market. So, Mr. Jain, I'll throw in the most important talked about ingredient. If it was budget on Saturday, today it is Trump and tariffs. Is the world prepared for this tariff war? What is the preparedness of financial markets, assuming that everyone knew that this was coming the day Mr. Trump was elected?
So I feel if you look at the current account deficits of US with their trading partners, India is way down in that list. It is extremely small. And it is well known that India is basically largely substantially a services exporter. Where tariffs I don't think are on the table, it is also difficult. So India is not a manufacturer. In fact, we have a huge manufacturing deficit with the rest of the world. So I think these tariffs should not impact India meaningfully. That's what I feel. Now, what these tariffs do to dollar, to DXY, to FI selling, that could impact capital markets, that could impact equities, and that is what we have seen. And in the past, whenever DXY has done extremely well, whenever DXY has appreciated, we have seen considerable amounts of selling by foreigners. But at times like this selling does not last indefinitely. So I think we are already underway 4 months of intense selling. It could again continue for some more time, but I feel that in the next 1, 2, 3 months, we should get invested in large cap stocks because earnings are not dislocated there. our multiples are in line with the likely earnings growth rates. Very significant amount of selling has taken place, and local flows, I feel, will sustain. Though their composition might change over time, more towards large caps, less towards thematic funds, less towards small and mid caps. And the dilution in Nifty stocks is hardly there. So I feel Nifty will find a floor, and in fact, the returns in similar type of stocks should be reasonable over time.
So, is there a way we can establish that why are FIs selling, how much more they could sell? I mean, will they sell more if dollar strengthens? What is the template at work right now?
So I don't think, Nikunj, this even the foreigners themselves know, because while we club them conveniently as FIIs, but they are a very disparate group sitting in different parts of the world, having different structures. Some are endowments, some are long only, some are hedges, some are investing from EM funds, some are investing from India dedicated funds, so on and so forth. So I don't think even they would know what they are going to do collectively, or even an individual manager may not know what he or she will do or will have to do 1 month down the line. So I think this is the nature of equities, that short term is very uncertain. And but in the long term, we have seen there is a very good correlation between valuations at the time of investments and the medium to long term outcome of those investments. So I feel given India's lower cost of capital, and please bear in mind that the gap between India and US interest rates is the lowest ever. It is at 2.2%. I have spent almost my entire career observing that number between 4 to 6%. So that tells you clearly that India is now a lower cost of capital country. So I think in Nifty, the multiples are quite reasonable, especially bearing in mind the lower cost of capital. So I think the risk reward in Nifty and in similar stocks is turning favorable. And I would suggest that in phases over 1 to 3 months, one should get invested whatever you would like to invest for the long term.
So I'll wrap it up with two more questions. And one question is that I'll look at your template which you follow. Buy companies which will grow in and around nominal GDP, which are available at reasonable price. And 3 to 5 years out, where do you think there is potential for earnings growth which could be in and around India's nominal GDP? Because like you said, P re-rating nahi hoga. That is not going to happen at this level. Now it's about getting companies where you can predict 3 to 5 years of nominal GDP plus minus 2% growth. Where do you see that happening apart from banks?
So Nikunj, I feel there is very little room for margins to expand. So if you look at most sectors, whether it is banks, whether it is manufacturing, whether it is consumer staples, I think margins are pretty healthy, and there is very little room for margins to go up. So I think profit growth should broadly track top line growth across most sectors. Now you have to figure out which sectors could grow faster than nominal GDP, and which sectors how are multiples realistic to those higher or lower growth rates. And you can make money both in faster growing and slower growing sectors, but the key is to not overpay for what is a realistic growth rate. I feel in terms of growth, consumer discretionary and capex should grow faster than overall nominal GDP growth. And I think the multiples are somewhat reasonable in large consumer discretionary stocks, especially in automobiles. In few other spaces, they are still quite expensive. And but one should be alert if and when prices are reasonable, one can take advantage of that. I think in capital spending, while it will grow faster, I think the implied growth rates are way too high by the current valuations. And I think we have also seen a sharp uptake in margins in many of these companies. And I'm not so sure if these very high margins can sustain, or if there will be some mean reversion in those margins as well. So I would be cautious on this space. See, what we have observed time and again, whichever stocks, sectors, themes, narratives become extremely popular, they typically underperform, they typically disappoint. And the reason is very simple. What everyone wants to buy is probably expensive. And that's why I think in the last cycle, this manufacturing, capital spending, it was a dominant theme. And you have seen companies go up from 20, 30, 40 multiples to 60 to 100 PE multiples. So I think that is one space, despite growth, I would still be somewhat cautious.
If you like this video, then like, share and subscribe to ET Now.